Hi, everyone. Thanks so much for coming this morning. I've got a great panel here for you guys to perhaps hopefully learn about what, as investors, to some extent, what we think about when we invest in early startups. And secondly, and hopefully touch upon some of the things you as people who are in the audience who are founders should think about when they're looking to bring on both investors and advisors. So I'm going to let you guys kind of introduce yourself. So Francis, do you want to sort of kick off first? Sure. Here.
My name is Francis Wong. I am not an investor. I come from the other side of the fence. I have two technology companies. First launches at the end of this month, essentially accelerating physical cash in the world. And the other one is directly rooted in building infrastructure to secure cryptocurrencies and cryptographically secure objects in space.
Hi, I'm Chef. I used to be a founder myself and now moved to the venture side. We run IOVC. We invest in early stage startups, specifically in enterprise solutions, in data technology, and in blockchain. Two of our portfolios have grown to be unicorns, so we can definitely talk a lot about what we see in them early on and how they emerge and what are they thinking about blockchain as a alternative business model as well. In addition, we also run the largest Chinese engineer entrepreneur community in the Bay Area. I'd love to connect with you guys offline after the panel.
Awesome. Amit, Pradhan. I wear a couple of investor hats. I'm the president of Silicon Valley Blockchain Society, which is an investor, a large institutional investor-focused network with the mission to what we call fund the revolution. We're very different in that we're focused entirely on the capital side. We love that there are meetups in community and all these different groups. We represent over $1.5 trillion in assets under management, and we work very, very closely with these investors to bring that money into this new asset class. My other hat is a general partner at Jet Ventures. We're a corporate venture partner-driven fund. We invest in companies around the world, cross-stage, a lot of focus on AI, and now obviously on blockchain, being an entrepreneur for the past 25 years.
Hi, so I'm Renu, Bhatia, and I probably traveled the most to get here, because I came from Hong Kong. I'm on the board of the Hong Kong Blockchain Society, and we're looking at how to position Hong Kong as a hub for blockchain technology and how we can extract the technology to basically position ourselves as a gateway into China and as a hub for companies looking to come out of China into the rest of the world. I also have another hat. I'm also an investor in this space, in early stage companies, coming from the traditional venture capital side and from the traditional financial services side from a corporate finance perspective. And then lastly, I've also been an entrepreneur, and I've sat on the other side and negotiated term sheets, and let me tell you, I know which side I prefer. I much prefer to be on the side with the money, because extracting money from VCs has been very hard, so I have a company of my own too. And our last panelist, who's just joining us, is Christian. Christian, can you introduce yourself?
Sure. Thank you. Sorry, guys, running out from a different panel. Christian Ferri, President and CEO of BlockStar. We are an advisory and capital fundraising firm out of San Francisco. We help companies with ICOs, STO, securitized token offerings, capital fundraising, roadshows, enterprise tokenizations, and all those kind of things. I've been advising, investing in the space. I'm currently writing a book about it. It's going to come out in September. Yeah, I think it's exciting to be here, so thank you for having me.
Okay, I'm the last one. My name is Ferri. I'm product director at LATOKEN. What we have right now is a multi-asset exchange. One part of why I'm interested personally in this topic, that we are building a compliant marketplace for token sales. And definitely part of my job and part of what we're doing we're evaluating a lot of projects to be presented at our platform. So what we look at is why these projects will be interesting for investors that are registered at our platform. Yeah, who want to start with a share opinion about the topic?
Yeah, I'm happy to. I mean, I guess let's start by identifying how many of you in the audience are on the startup side and raising funding. Okay, that's probably the majority. It's good. And any investors? Institutional or angel? Okay. And focused on the blockchain side and tokens, or just starting to explore? Okay. So I think there's kind of two ways to look at the challenges around finding your anchor investor and thinking about advisors. If you look at traditional venture and the way that we look at, from a Jet Ventures perspective, we look at why companies need advisors. The money is a means to an end, right? If you get the right advisors, they really, really change the trajectory of your company. So for me, I would say that comes first. In the traditional ICO space so far, it's weird even saying traditional for a space that's 1 month old. But in the ICO space, it's almost become kind of like a prerequisite. And if you throw on the right advisors onto your deck or onto your white paper, then somehow you become eligible for going out and raising funds. And I think that's the immaturity of this space. That will change. In the pure VC world, we look at advisors as being actually the key people who will participate on your team to help you go in the direction that you need help in going to. And most of the times, they will actually help you with identifying capital. They'll help you with the sale to the VC. And from a VC perspective, knowing that you have those advisors on board is actually incredible due diligence. So I would almost, therefore, urge the reversal. When you look at advisors now in the ICO space, I think most companies are kind of just saying, look, we need to have 8 to 12. They need to be relatively big names. Let's somehow find an in and throw those on. And I would actually encourage you to think very functionally. What is it that you're trying to achieve as a project? And then look at all the different aspects of that project that require help. And try and bring on advisors who are absolutely the best in those 3 or 4 different areas. The more mature investors, and we're heading to a more mature market, will appreciate that a lot more than everyone looking at those same 3 or 4 names in common that were brought and thrown on. Finally, on the anchor investors, I think initial investors are very, very critical, much like you get the right advisors. And I would even say focus on the first 3 or 4 advisors. In the same way, focus on the first 1 or 2 investors, because they're going to really signal to the rest of the investors as well as to the community as to why this project should be invested in. And I won't hog up more time. I'm happy to go into more details of how we think of anchor investors. We have both types because of the sheer scale of the assets that our investors are managing at Silicon Valley Blockchain Society. We have a lot of experience and thoughts around how you bring the anchors in. And then obviously with all the companies that come through, we look at about, I would say about an average of 35 to 40 projects, really high quality projects a month. And we get to really see what works for them the most when it comes to bringing in the initial investors. So just some initial thoughts, yeah.
I think you're right. I think the word advisor has been used completely, it's a misnomer in the ICO space, because it's difficult to take advice from 20 people that are just listed as faces I think all you're trying to do there is to try to use their network and somehow community reach. So I think the word advisor is a little difficult in that respect. I think, but you're right, I think we have moved on from that space that we were in 2017, where a paper and a huge bunch of names kind of helped you raise the money. And I think where we're moving to going forward is this idea of more of a traditional corporate sort of structure in some respect, which says, here's the product we're looking to build, there's more of a roadmap, and then we're trying to bring in perhaps an investor, and typically they're often coming in and in the private sale perspective. They're coming in, they're helping to mold and shape that company as to how it looks towards financing. And with that come a key advisors. And I think when as founders, you're looking at it, I think you have to look at it from a few different perspectives. There is the capital that investors bring. There is domain knowledge and know-how, and how deep is that knowledge. And it's not, perhaps they may not be the most obvious blockchain, but they bring industry knowledge that needs to be important as you build your product out. And then they bring their network, that's when they're going to open up the doors. And it's that reputational component which allows you to access that capital. And that's your key, not just one, but 2, 3 big investors, not necessarily even the largest money-wise, but all those social capital, reputational capital, business capital, and actual money. And then you bring on some key advisors. And I think the other thing is you also have to look beyond Silicon Valley as well. I think going forward. Because too much of it was actually concentrated in this part of the world. And as we go on into this space, where you're building a global business straight away, because traditionally we've built businesses were sort of much more local, and then they thought about international expansion. Now, in this kind of blockchain decentralized world, we're building a global business from day one. And so when you're building those anchor or key people to be involved in your project, you do need to think internationally and what that means and what to take that into account. So look beyond your home market, look beyond Silicon Valley. And I know Silicon Valley thinks they are the epicenter. But,
I think there's been an interesting change, right? So in many ways, yes, because a lot of, growth capital is going to come from here anyways. But yeah, I mean, look, blockchain has really completely, especially in the token sales space, right? That's changed so much. There's more capital coming in from Europe and Asia than there is from here.
So you need to look at that, and that should be reflected in your investors and also your advisors.
Absolutely.
But the other key element that I think is slightly different between the two, between the traditional VC world and the other, is the compensation aspect of these advisors. As you mentioned, there's 5 names or 10 names that seem to be on most lists. How do we, I think there is a conflict in many ways as how they're compensated and their role going forward in the company, or whether they sell out. And I think all of that is changing now, and I think we need to talk about that.
I mean, one of the things on that point, actually, we've when you focus on advisors who truly are invested in your business and they truly believe, then they should be writing checks as well, right? And so you start getting away from a little bit of the conflict where just like people throwing, yeah, sure, throw my name on the deck because I'm going to get tokens or I'm going to get cash, post your raise. I think advisors should only be in companies that they truly believe in. And the sweetheart deal for them for truly believing is to come in at, either a deeper discount or come in with equity or, whatever it might be. But I think you should have your core advisors should be people who have written checks into the company. That's a nice little benchmark.
And along with that, it has to be time. Along with that has to be time commitment. And I think a lot of the issue has been no time commitment apart from saying, here's my network. What do you think?
Yeah, so I would like to actually take a step back. So as a traditional venture capital in Silicon Valley, so 2 for 2. So if you think about currently the ICO projects that are raising millions or dozens of millions, the quality of their project wouldn't pass our IC meeting for seed investment in the traditional finance world. And that is insane, because why should you be paying premium just because it's blockchain? Many of the project doesn't even use blockchain technology, just a name. And that will change. Gradually we see the standard for crypto project versus traditional projects are converging. And that speed of convergence is faster for exchanges, which is eventually where you want the exit. So if you're doing the project right now, you're aiming for an exit in year and a half. The environment when you exit wouldn't be the same. And then, the quality of a project will actually matter. So I would actually urge whoever is doing a crypto project to actually take a step back, to go back and think about your project. Does it actually require blockchain technology? Does it solve the 4 problems? Does it better, cheaper, more, and faster? Right? Does it provide those quality to the services, to the audience that you're talking about? And then as you build around all of that, then you can talk to investors. Those names that you said will actually count and bring you credibility. And to find advisors that will actually commit their hours on weekly or even monthly basis to help with your project. But I actually absolutely agree with trying to convert your advisors to your investors. That's absolutely essential.
But it's also to that point, there's an evolution of, like, we are in a very, very young industry, right? Absolutely. And it's easy as investors to criticize how, projects are still immature, and you need to look at, it wouldn't pass the smell test of a traditional IC. And I think that's true, and that's the maturity that we're starting to see come. You're not going to be able to raise money today like you did a year ago. And that's just because our industry is maturing. 2017 was all about first-time founders, right, building the sexy new protocol. 2018, for the first 6 months, we've seen repeat founders trying to solve either a business or a consumer problem, right? And that's just, we've seen this through all the cycles. And I'm okay with that,
Yeah, absolutely. I'm just saying that because there's a time lapse for what you're doing right now versus when you exit, right? Yeah. If you're in the traditional finance world, you're in venture capital, you would expect the market to be more or less the same. If your company grows to a certain stage, then you're expecting certain finance happening. So for us, it's really, if you can almost see a project as an onion, right? As it grows, you're peeling off different layers of risk. You're peeling off product risk, you're peeling off team risk, and you're peeling off product market fit risk, and then you're peeling off growth risk, and then you have a company that is mature enough to, go to IPO.
I think one other difference between, I just want to pick up your point about seed capital in terms of the maturity of these initial companies. The big difference is in the VC world, a seed capital is a small amount of money that's been raised. But the interesting thing about this, particularly last year, less so this year, is the significant amount of money that's been raised by these early stage companies. So what that does is it alters the risk balance between a company and the checks and balances. Because in a traditional VCs, you had a board and you had VCs, investors, et cetera, that had a checks and balances on how the capital was managed and how the company was, the product and the roadmap was developed. What you've got here, particularly last year, was this complete lack of checks and balances, large sums of money being raised with very early companies, and some of those accountability parameters have not been there. And that's important because they've raised very large sums of money, and if nothing else, you've got treasury management issues to do with significant capital that's been raised. So I think that's an issue, and then I think the exit strategy that people are talking about, 18 months, I think that will change very dramatically, because normal VCs, you're looking at 7 to 10 years to get out. Now you're looking at a shorter time scale. However, that gets into your subsequent rounds of financing. Because if you're looking to sell your company to a Google or a Facebook or something in 2-3 years' time, you actually need to be much more careful about how much money you raise at this stage and subsequent rounds. in such a short period of time, which has not been so traditional, and we don't have as many parameters to judge how to do that.
Right, but I think to that last point, that the movement will argue, the revolution will argue, that we're not building companies to sell to Google or Facebook any longer, right? We're actually building companies to destroy Google and Facebook. We believe that these centralized monoliths are the problem, and this is why we all participate in this revolution. And so we almost don't care, right?
So that's, this is kind of where I want to chime in here from a historical observation standpoint, and from the side of the person that has to go out and raise the money. I would say exceed the current standards of the investment landscape altogether, right? So I agree with you that the maturity of the projects coming into this space are primarily gold rush projects. They are the equivalent of saying you had .com back in '98, so here's a couple $1 million and do something. I will disagree and say that the question of whether or not to use blockchain is an easy answer. It's yes. I believe if you have assets, they are not tokenized on the blockchain, will be the equivalent of someone saying, or Walmart saying, we don't need internet presence because look at us, we are retail. And now they've spent the last 8 years catching up to online presence, right? So for me, I think the money part is easy if you exceed the standards, right? So right now, we're in this cycle of grow 20% year over year, or that's the financial objective. I think the flip side to that opportunity is to say, if you can exist for as long as humanly possible, if you can exist beyond your interests of a single portfolio, a brand, or your own career, that's when you begin building stuff for intergenerational length, which means now you're looking at things like societal impact, environmental impact, financial equitable structures. Essentially, you build a good company, right? And then you're not shilling the company to try to, raise money quickly. You're actually looking at something at the system level, right? So essentially, if you haven't gone through the exercise of looking at your product, not only what it's solving, but the system in which it exists, and if you're not impacting it at the open system level, then you just haven't thought deeply enough. I think what the blockchain, crypto movement is all about is to increase the standard of the projects that are out there and the missions of those projects.
So, go ahead. Yeah, absolutely.
That's okay. That's okay. Thank you, though. So just kind of bring it back to advisors and investors. So the simple answer is appeal to what they care, right? Appeal to what they care. I'll let it sing for a second. Is it sinking enough? Advisors, start with that. In ICOs, IMO have been used mainly for marketing purposes. And you guys can disagree with that. And I agree with my fellow panelists. I think there's very little value that most advisors bring to the companies. And what's more concerning to me is not really the support that advisor can provide for the ICO. I'll connect you to some investors. I'll connect you to some potential customers. We're going to go on a roadshow. And half of these promises fall flat on their faces. What's more concerning to me is the support that they can actually provide post-SEO. Because guys, getting the money, it's easy. That's the easy part. Building a company is the hard part. And I like to see how these advisors, and I'm one of them, so I know the folks around me, they have the guts and the bees, and I'm not going to say that, to actually help the entrepreneurs and the teams to build a company. That's extremely hard. And most of these folks, they're not entrepreneurs. They never built a company themselves. Basic stuff like staffing, scaling, even getting a customer, pitching to an investors, it's new. So how can a person like that advise? right? So that's what I'm going back is mainly marketing, right? There's a lot of faces on this website, right? And they get paid a lot of money, right? I get paid a lot of money, right? But the difference is the value that is provided. So that's number one. As far as the investors goes, again, I think there's a lot of investors that have a huge amount of FOMO. Blockchain, right? You know, my company go through 300 requests per month. We have a due diligence teams overseas to screen them all, right? And we get 300, 1 or 2. I was saying in the other panel in the other room. Because 99.95% are total moonshots. And I was saying before, it's like, I'm reading these white papers, right? Just kind of pick them at random. It looks like they're trying to build YouTube when it's 1992, right? Remember in 1992 we had a dial-up, right? Remember the sound of the dial-up? You can't build YouTube when it's 1992. You can't. You need a broadband. So the idea is a lot of these investors are not real investors, are people driven by FOMO. And the question is up to you if you want to get those people on your board, if you want to take money from those people. Remember, careful what you wish for. Careful what you wish for in terms of advisor. Careful what you wish for in terms of investors. Because these people might actually hurt you more than helping you, right? So to answer the questions, and I'll cut it short, is think first if you actually need advisors. Think first if you actually need investors. And if you do, figure out exactly what you need, and to be a value exchange more than a marketing play. Marketing is easy, you just need to pay, right? But if you have value, you shouldn't do marketing in the first place, right? So the question is why companies pay this exorbitant amount of money to have faces on their website if they truly believe that their technology and their project and their company is so valuable. It's an oxymoron, isn't it? Right? So I'll leave you with that, but that's my thought.
Is it probably a good idea to turn this for a little while to like the audience questions that are specific, and then we can respond to that depending on how
I think we have still about 15 minutes, so if somebody else wants to share.
I do want to pick up on one thing, because I think what you said is actually very valuable in terms of what you wish for and the role of the advisor and investor within the company after you've brought them on board. Because one of the trends that I'm seeing in 2018 is particularly for companies that are bringing on potentially perhaps anchor investors early on before they do the public ICO, having clauses written into the agreement which gives them rights over when that ICO, public ICO is done, or they have the potential to stop that, which goes to your point. You know, if you have a long-term roadmap and you have a belief in how you want this company to grow, you know, be careful who you bring on. Do as much due diligence as to what their imperatives are. Because if you have a desire to do an ICO and you've suddenly got this clause in, you may not be allowed to do that going forward or have that degree of influence. So this landscape is changing very, very quickly. What was true 4 months ago isn't true now. So you as founders or people looking to bring on investors and advisors, do your homework a lot more and see what really is happening now. As I said, this is a very recent trend.
Sorry, so just because you mentioned contract, I don't know about you guys, but you know, people are signing contract in record times. Like you send out an agreement and they get signed, they sign it right away. They don't even read through the 25-page contract, maybe because it's boring. I don't know, they don't have legal counsel in-house. But if you're an ICO in a small company, you still have to review that contract. Because just like she said, like, you might be signing onto your death. Think about it, you go ICO, you raise the money, and then the company is doing okay. Now you're thinking about an equity round with some VC in Sandhill. And then it comes to diligence times and say, well, I signed this contract 5 years back with this advisor, and then you can't raise because they say, no, this is a clause that we're not going to buy with. So a lot of things you're going to be doing today, if you're raising money through an ICOs, are going to be following you 5 years out, 10 years out, right? So read those contracts. Make sure that any contract, advisors, board of directors, team members, partners, right? I don't want to drag it on, but it's really important, right? Because once you sign, you're liable.
Okay, I think now we can start a small Q&A session for 10 minutes. So who has questions? Nobody? I didn't expect that.
Right. My name is Paul Siska. I get that you mentioned earlier that advisors should have writing checks and provide commitment of time or either one. But do you see any value or any idea or any circumstance under which you could get advisors to be paid, high quality advisors?
So I have no problem with compensation to advisors, much like you compensate other people in your company that are providing value. I just think that if you're doing it because that person is, gets put onto your website or gives you that cachet value and you're going to get some money from the market because of that, in the short term, it serves your purpose. I think to your point, like, stop thinking just as far as your nose. I know that when there's a lot of money on offer, especially this has been the case for the past, 18 months, we're all thinking, yeah, whatever. We'll figure out our long-term strategy, right? When we have 10 million in the bank, it's very easy to figure out our long-term strategy. And I think, in any case, the market forces are changing. You're not going to have that 20 million sitting there because you did nothing. So I have no problem with compensation of advisors. In fact, they should be compensated. I just think, we shouldn't be, I get invited to be on, like, I don't know, 10 projects a week. And, it's just like, oh, but I just need your name. No, that's not what you need. I'd like to think that I can bring value, and it's very specific value, and I can't do it for 10 projects a week. So I should really, really carefully pick the 3 or 4 or 5 at the most that I would be involved in, and then add value to them. And if I get compensated for adding value, that's fair. But I should, if there's 5 I want, then I should write a check to those 5 as well, because I believe in them, right?
I'd like to hear a little bit from you, since you're an entrepreneur. You actually managed to get a good advisory board. What is it how did you go about this? And does it differ from what you did in the US to what you did in Asia, for example?
Yeah, so for my company, we essentially set out to get advocacy for the product. So essentially designed a product that we could essentially make money and be profitable and sustainable while remaining free to all of the constituents of our system. So for me, my specific strategy was advocacy. From there, that support, just essentially endorsement type support. So I approached local governments, wrote letters to legislators that made sense to us, attended any and all conferences and everything, met people, put myself into uncomfortable situations. Essentially, that led to a combination of being lucky and persistence. And we managed to, through finding the very first advisor on board, who also cut me a $25,000 check and said, don't accept this job offer, spend at least another month just thinking about this a little bit more. And that essentially changed the entire course. It made me go all in with the company. And from there, really finding the key. If you've done the system exercise and you can sort of understand the tenets of success and the tenets of your business, find people that are specialists in each one of those and learn from them, right? So we are trying to speed up cash. Jim Lane, who is the guy who opened up the private equity side of Goldman Sachs, is our advisor. Travis Mason, because we're helping the Fed and the Mint, we brought on Travis Mason, who now does global policy, did it for Google X, now is doing it for Airbus, knows everybody in Washington, can really help get this message out to the people that matter and help us navigate those waters. we have a charitable responsibility to nonprofits, and without getting into detail, we brought on essentially the Chief Donation Officer for World Vision, who is helping us create the proper technology interfaces that make it easy for nonprofits to plug into our system and benefit from it. So all of that is going to look different from company to company, but it's really up to you to really understand every facet of not just your business, but your vision and why you want to live beyond 20 years. So luckily for us, the first advisor, he's an author and actually advised a bunch of these people. Jim Lane then connected us to people like Travis Mason and people doing stuff for nonprofits, since he's sort of reached that place in his life where, and then essentially it's once you get that first like believer, someone who I agree with you, puts skin in the game and essentially allows you to take that next step and is really committing time and energy and all of that. It should be for, the table stakes there really are that that person can help with the mission of and vision of the project, right? You're not going to do it simply because it's like a great person, right? So with that said, the table stakes sort of is that you do be very persistent about having them open their network and go and meeting people, and you're not going to be everybody's cup of tea, but
Christian, this question's for you. I want to give you the lens through which I look. I'm a reformed corporate securities lawyer through the tech boom. I've been an investment banker for tech for 15 years. I'm an entrepreneur for 10 years, and now I'm starting a blockchain company. So I'm a pretty sophisticated, legal, finance, operational person. You said, why pay money to put faces on your website, collect advisors around you, if you think what you're building is special? I think what we're building is special. In fact, I know it is from what I've learned in the last 6 months. But I'm a pretty sophisticated finance person. I know nothing about this realm except for what I've learned in the last 6 months. I mean, I've got one senior crypto advisor. He's awesome. But my question for you is this. Suspend your disbelief for a moment, put yourself in my shoes as an entrepreneur, and tell me what the alternative is. Please.
Question. So let me see if I get that right. So impressive background, by the way. To me, it comes back to one thing, is that don't rush it in. It sounds like it's a simple answer, but I don't want to kind of tag it that way. It's doing enough research, talk to enough people out there to understand a bit about who are the players in the space that you're playing in, and spend time with them. For example, before I sign up on an advisory agreement, I need to see the people in the team at least 3 times. So the time will tell me if these people are real or not. I can't sign them up. So it takes time. It takes time, right? Just like when you find a mentor, right? And I bring that example because an advisor, it's a good example, but mentor to me is an even better example. Would you ever want a mentor that you sign up in half hour that you don't really know, that doesn't really listen to you, that doesn't really understand? I wouldn't, right? And I have a mentor in Los Angeles, and to find that person, it took a long time, right? It was like spending time with them, going to dinner, going to travel with them, be in social settings, understand the person not just from a business standpoint, but also as a person. And the personality matches is huge, right? Because eventually, a company is really stressful, right? And this person have to be there for you when those stressful times arise. So if that person doesn't kind of match up from also a personality perspective, which is the basis, that's not the right fit. So on top of the technical, I'd like you to look at the basic, the human aspect of a person you're going to be working with. Does it help a little bit?
I think we have the time for just one question. The last question.
So you guys talked about how the market is maturing, right? The industry. what happens when a company is the first one to be overly mature? So they put vesting schedules, not the minimum, like you get your tokens immediately, the founder tokens, or you see in some white papers 180 days or 240 days. What happens to the company who says, we're going to vest over 4 years, we're going to make our advisors actually advise, and they're going to be vested as well? Does that scare away like investors like yourself, as well as like individual crypto day traders? What happens to those guys who become mature too soon?
So I don't think, on one hand, that's scary, right? This is an investor class that has been used to this for a long time. There is a flip side, which is traditional VC is being disrupted right now. And it's being disrupted because of this liquidity that is appearing in this new asset class, right? So even traditional, hardcore traditional funds are starting to create these token vehicles. I think we'll see these best practices evolve. You're already seeing companies that are much hotter in the market, not offering discounts, or instead of offering discounts, offering different terms on the liquidity of the token. And so I think all of that will happen. All of that will evolve. Whether we get to a point where it looks exactly like traditional VC, I don't know. I actually think, coming from traditional VC, that we're ripe for disruption on many different levels. So it's not the worst thing that happens. I think we'll see something in between. I think you may not see a 4-year vest on the same thing. But if you were to see 18 months or 2 years, or if you were to see different terms on the token depending upon how long you kept it, right? I would be completely okay with that.
I wouldn't have any issue with a vesting schedule that's different. You actually want value-based investors. I think what you saw last year were a lot of purely financial investors coming into the market who were sort of investing in May, June, and basically selling out November, December. So I think going forward, that sort of frenzy has disappeared. So I think people coming in are actually coming in. I think there's different money coming in. So I think more family offices are coming in. And I'll speak from an Asian perspective because that's what I'm more familiar with. So I think, last year it was very much the guys who raised money had more cash around, invested, looking for shorter term gains. I think now it's emerging as an asset class. So you're looking at different type pools of money coming, family offices, high net worth individuals who are putting this as part of their portfolio. They have potentially a longer term vision into this. So I think that's changing. And before really big capital comes in, I think we also have to solve a lot of the security issues around custody and many aspects of where we keep all of these, large pools of money. And that makes an issue because a lot of mandates doesn't allow for sort of private keys aspects in cold wallets. So I think we do have to solve for some of that before you see really large pools of money coming into this.
Unfortunately, we ran out of time. Yes. Thank you for discussion. Thank you. Thank you, guys.